All right, guys. So today we are going to be going over the hugely controversial term versus whole life cost of insurance. Now, you might be thinking to yourself, Shawn, there's no controversy there. Everybody knows that the cost of term is far less than the cost of whole life. What if I told you that you were wrong? What if I told you that whole life is actually going to be way cheaper when it comes down to it than your term coverage was? I know you probably wouldn't believe me because you listen to these gurus like Dave Ramsey, Susie Orman, all these people that are out there telling you that whole life is way too expensive. It's a bad investment. I do agree with that. It's not an investment. Nobody ever said it was an investment. And if they did, don't listen to those people. But Dave's over here telling you, hey, you guys, buy term and invest the difference. Let's be honest. Nobody is investing the difference. Maybe a very small percentage of people. And actually, we have statistics. We have people that have done the work and found out that less than 5%, count them 1, 2, 3, 4, 5% of people actually buy term and invest the difference. So we can't say that that's what people are really doing. And I definitely don't want to hear that as, oh, Shawn, I see these numbers and what if I just bought term and invested the difference? You don't do that. You don't do that. So quit lying to yourself. If you do that, let me know how that goes. We also have paperwork and statistics and studies that show why buying term and investing the difference is still going to be worse for you in the long run. But in this episode, in this video, we're going to discuss why term is actually more expensive than whole life. So here we go. What we're going to look at here is a company called One America. One America is a fantastic company. They've been around for a long time. I'm talking 150, 160 plus years. They're A-rated in the industry, which is not something that they just hand out to people like they did in elementary school when you were able to trace around your hand pretty well. They're not saying, oh, little Jimmy, you get an A for this. No. You have to be at a certain status. You have to have a certain amount of assets, liquidity, all of these things to be considered an A-rated company. So One America is an A-plus rated company. Very, very strong. Strong. That's what that means. So we're going to do a comparison between a term with One America and whole life with One America. Not just any type of whole life, properly structured, participating whole life through a mutual company, which One America is. Now, normally we would structure one of these policies to use it for infinite banking. But if I showed you using this thing for infinite banking, it would blow these numbers that I'm going to present to you out of the water. And so we're not going to do it in that way. We're just going to do a cost comparison. And I think you guys are going to understand the point I get to by the end of this. And I think you'll really start to get it that, damn, term is a whole lot more expensive than whole life. So the example gentleman that we're using today, his name is John Smith. We got Thanksgiving coming up here, Pocahontas, John Smith, sticking with the whole theme. But as we scroll down here, we're going to get to basically just the basics of John's term policy. So this is a 30-year term. John is 30 years old at the moment. He's extremely healthy, so we got the preferred non-tobacco rating with One America. And what we're doing here is we're trying to compare this as evenly as possible, apples to apples. So John, if he went the whole life route, the amount of money that we would be starting at is $389,000 in death benefit. To be specific, $389,200. So for his term, we got him $389,000 because, again, we want these to be equally comparable. So for that $389,000 at that preferred non-tobacco rating, John would be paying $516.79 a year. Now, you may think to yourself, man, that's less than $50 a month. That sounds pretty reasonable. I think Shawn's going to have a pretty hard time convincing me that whole life is going to be cheaper than this less than $50 a month term. pump your brakes. Let's wait just a second. So as John goes through his 30 years, he reaches age 60. And at 60 years old, John, surprisingly, is still alive. He hasn't passed away yet. And you may be thinking to yourself, well, he could. And yeah, that's true. He could. But we like statistics here. We like numbers. And statistics say that less than 2% of term policies actually pay out. So what he did was essentially rent that coverage, that $389,000 for the past 30 years, paying that $516.79 over that entire period of time. But what he did get was his family or whoever being protected with $389,000. What didn't happen is cost didn't increase. His death benefit didn't go up. But what also didn't happen is he didn't have access to any of the money that he was spending on the term over that period of time. You pay, they rent you the death benefit. If you don't die, it's over. Okay, so at the end of this, John has spent $15,503. Great. He's still alive. So we're going to have some sort of a decision to make as we go on here. But let's take a look at his whole life policy and compare it up to that point. So here we go. This is where you guys are going to be like, Shawn, you lied right to my face. Well, John Smith, male, age 30, prefer non-tobacco, same rating, $389,200 death benefit, was truthful on that. But he's paying $10,000 a year for this. Oh my gosh, that's unbelievable. Before we were paying $500 and something a month or a year, and now you want me to pay $10,000? Hold on a second. So, if we look at his illustration, we can see that John pays $10,000, $10,000, $10,000. He pays $10,000 for the first 10 years. That's $100,000 total. You were showing me that you only paid $15,503.70 for the entire 30 years of the term. Shawn, you got some making up to do because there's no way this whole life policy is going to be less expensive than this term. Again, hold on. So if we take a look at the total net cash value here, when John pays his $10,000 in year one for his $389,000 death benefit, he has access to about $4,884, give or take, of liquid cash that he can use. Now remember, I said we're not going to use this for banking because if we did, it would blow these numbers out of the water. We'd be talking about 2-3 times the size of the numbers that we're actually seeing here. But in this example, I just want to let you guys know that this cash, total net cash value, is liquid. This is accessible. So as we go through this time, if you wanted to, if you needed to, we highly suggest you get in here and use this money to go make you other money. If you want to talk about Dave Ramsey, buy term, invest the rest, no, buy whole life and then invest your money. It's the and asset. It's the ideal asset. But again, we're not going to be doing any of that here. I just want to show you the numbers. I want to show you why I believe whole life is less expensive than term. So as we go through this process, we get to year 10. And like we said, we put $100,000 in. What's going on here? You can see that, well, we've put $100,000 in by year 10, and we have access to almost $97,000. And look at this over here. What else has happened? Our death benefit has grown to about $586,000. Well, I paid $15,503.07 for my term for 30 years. My death benefit didn't go up. I couldn't access any of the money. And at the end of the 30 years, when all was said and done, and I didn't die, I didn't have anything. And you're telling me at this point, I've put in $100,000. I have access to almost $97,000, which would be considered basically 97% if I did my math correctly. That means about $3,000 I've paid total of money that I don't have access to up to this point, and I have a bigger death benefit. And we're only 10 years in. Okay. I'm listening. You got me. So as we get to year 12 here, you can see that John's annual payments have decreased. He decided, you know what? I'm not going to put extra cash into my policy. I'm just going to pay the base amount. Cool. So the base amount in this example is $5,000. So John continues on paying $5,000 for the rest of the life of the policy, which is up until age 65. But I want to point something out to you guys. With zero banking, because again, remember, all of this would happen much faster if we were banking with this thing like we teach. With zero banking at all, by year 12, John has put in $110,000. That's 100 right there. And an additional 5, 10, $110,000. But he's got $112,000 in cash that he can use. So he has all of his money that he put in to his whole life policy accessible for him to use, take out, use, lose, or abuse, whatever he wants to do with it. And he also has a $595,000 death benefit. So what you could really say is he's got a free $595,000 death benefit because he has all of his cash right here. Every single dollar he put in, it's right there. But let's carry on. Let's continue to see what's going on here. So, before we do that, what I didn't mention at this point is John has a cash flowing asset. He's built himself a little something of a bank here. And what I mean by that is if you look at year 6, from year 5 to year 6, what do you notice? You notice that the increase in cash is slightly more than $10,000. So he put in $10,000 and it grew by a little over $10,000. We're talking about like 10,180. I don't know. I didn't do the math exactly, but you could do it if you're sitting here watching. So for the past 6 years, up until that point where he had all of his money back, your money that you were spending, putting into the policy, was actually making you more money. Very interesting. I don't remember term doing anything like that. But again, that's not what we're here for. We're not here to discuss how much money is it making us. We're talking about the cost of the insurance and how much money is actually going to come out of my pocket that I'll never see again. So we've established by year 12, you have every dollar back. So we could say right here, conversation over. I have every single dollar back, but we're not going to do that yet. So like I mentioned on the term, at year 30, John's term is over and he has a decision to make. And he could be, self-insured by that point. But I want to make this very clear. The amount of people that are self-insured in their 60s is essentially none. And what I mean by self-insured is you have all the money you need. You're not worried about anything happening to you, health-wise, death-wise, anything like that, because all of those expenses would be covered and you would leave all the money that you want to behind to your family. Well, very few people have $200,000 to $300,000 at that point in time in their retirement. I'm talking about like that's kind of where they're at max. So the chance that you have $1 million, $2 million, $5 million and you're self-insured at that point in time compared to everybody else in the country doesn't sound very likely. So what John has decided, because he's like, hey, I'm healthy. I'm kicking butt right now. I'm 60, but I'm feeling good. I think I've matured a little bit and I want to make sure that I leave as much behind for my family as possible. I want to go get more life insurance. I should take advantage of it because I'm still healthy. And so what the life insurance company says is, hey, you know what, John? You're 60. You're super healthy. We're going to give you another term policy. They don't say we're going to give you another term. He asked for term, and so he's getting term. Maybe someone suggested it to him. Maybe it was Dave. I don't know. But John gets another term. But the insurance company says, you know what, John? We can only give you 20 years because in 20 years, you're going to be 80. And at 80 years old, the risk of you dying skyrockets. I mean, we're talking about it's through the roof. The chances of you dying between 60 and 80, yeah, they're high, but after 80, I mean, good luck, sir. So that's what he does. John says, you know what? I'm going to take that 20-year term because, like they said, there's a decent chance that I die between 60 and 80. Now, again, John's super healthy, so chances that he dies aren't great. And we want to keep this apples to apples with his whole life policy. So with his whole life policy, at age 60, so the end of his 30-year, what would have been term, let's do a comparison. So he would have $752,458 in death benefit. Now, if we want to keep these apples to apples, that's how much he's going to get his term for. So John gets a 20-year term for $752,000. But before we go and we discuss what that term looks like, I want to show you a couple numbers on here. So we know that John has already spent $15,503 on his first 30-year term that he outlived, and now that money it's gone. It's gone. No more money. But he's getting this other 20-year term. So, maybe he'll die in that 20 years if he's lucky. But I want to look at his whole life policy. We already established that by year 30, he'll have $752,458, give or take, in his death benefit. He will have put in, at that point in time, $200,000 into his policy. Now, remember, he's only put in $15,503.70 into his term, which is gone because he's not dead yet. He's put $200,000 into his whole life. You guys are thinking, wow, those numbers are pretty crazy. But you remember what we discussed. He put in $2,000. Well, look at this. He has almost $345,000 in liquid cash that he could use. So if I'm putting money into something that's making me more money than I'm putting in, and I have access to all the money that I put in, it would be like the money's in a savings account and I could just go grab it if I wanted to. Did I really spend the money? Is the money really gone? No, it's right here. It's sitting right here in his whole life policy that he could go use. So that's very important to understand. On top of that, just like I mentioned before, year 12, he had all of his cash back. Year 6, he started creating a cash flowing asset that was only going to get bigger every year. If you look at these numbers, they just get bigger and bigger every year. And if we do a little comparison here, I want you guys to understand what he's built, what John would have built over this past 30 years. So not only does he have access to every single dollar he put in, not only does he have a $752,000 death benefit, but like I mentioned, he has a cash flowing asset. I'm talking about paying $5,000 in premium and it making him $13,406 in additional income, in additional cash. And I'm going to show you really quickly how I did the math to that. I'm just going to lay it out here. You would take $344,484. You would subtract $326,000. That's going to give you a number. We'll call it $18,000. You're going to take the amount of premium you paid that year, $5,000. You're going to subtract that from that number, 18 or whatever that exact number was. That's going to give you a different number. 13,406 will be what that number is. You're going to take that 13,406, you're going to divide it by 5,000, and that's going to tell you exactly what the percent is, cash on cash, when you put that $5,000 in that you're making on your money that year. That percent is a 268% return. Don't forget to move the decimal place 2 times. 268% return, cash on your money, and that's only going to get bigger every single year. So not only are you telling me that I have every single dollar that I put in, I have more than I put in. I have a bigger death benefit, but I have something that's making me $13,000 a year on top of the $5,000 that I put in, and that's only getting bigger every year. Shawn, I'm starting to come over to your side. This is making a whole lot of sense. But before we continue, let's pop back over to his term policy. Let's take a look at years 60 to 80. I want to see what's happening in that policy. So we got it right here, $752,000, age 60 is when he gets it. Preferred non-tobacco, still the best rating out there possible. And he's going to be paying $5,266.28 for that $752,000. And that's a year again. So we're getting close to, 500, I think it's like $438 dollars a month. And you may see over here that it says $458.17 a month, but it's actually less than that because you have a little bit of charge if you're paying monthly compared to paying annually. That's why I tell people pay annual. It's the cheapest way to go. But he pays that $5,266.28 for the next 20 years. Now, what you might be thinking is, well, weren't we paying at that point in time $5,000 a year on our whole life policy? And I would point out to you, yeah, you're right. You're actually paying more for the term now than you were paying over the whole life. Okay, so let's carry on. Over that 20-year term, you will have paid a total of $105,325.20 for that coverage. And if you die before 80, your family, your loved ones, they would have lucked out. They're getting a $752,000 death benefit. But because John was super healthy at 60, and with all these advances in medicine and life expectancy only getting longer and longer for both men and women, let's say that unfortunately John doesn't pass away. Shit. Well, again, we understand that statistics say that less than 2% of term actually pays out, so the numbers aren't looking great for John. So he gets to 80 years old and his term ends. He's still alive. Crap. What do we do? Well, John at that point has spent a total of $120,828.90 over the last 50 years on a bunch of coverage that, one, he didn't end up using. Two, he couldn't use a single penny of that $120,828.90, not a single penny of it. And he didn't die. So again, a lot of people would tell you, well, if you just bought term and invested the difference, he'd be in a better situation. You didn't buy term and invest the difference. So shut up. I mean, come on. Nobody's doing it. So what does John do now? Well, you don't really have any options. I mean, you're 80 years old. The average American like yourself probably isn't rolling in the dough at 80. So John has a couple options. He could either call it quits and just walk away and say, you know what? You beat me. I thought I was going to die before 80. I didn't. I took the bet and it cost me $120,828.90. Or what the insurance company says is, hey, you know what, John? Take a look right here. You could pay us $16,200.36 for next year, and we'll be nice enough to drop that death benefit from $752,000 down to $102,000. Not nice enough. That's what that amount of money is going to get you. So you pay us that $16,200 and we'll give you $102,000 in death benefit for that next year. Now, if you don't die in that next year, well, John, you know what? We'll just bump it up to $18,343. And don't worry, we're not going to lower the death benefit. It's still going to be $102,000. But if you don't die at 82, well, you can come back and spend another $20,817.64 and still get that $100,000 death benefit. So you're understanding what's happening here. John has placed himself between a rock and a hard place because he didn't die fast enough. I don't want to make a bet on when I need to die. Like, oh my God, 80 years old's coming up. I better hurry up and croak. I know that hopefully that's not what your family's thinking, but yeah, man. So not including all of those extra years, just up until the age of 80, like I mentioned, John had spent $120,828.90 that he'll never see another penny from. He'll never be able to use again. He was never able to use it over that last 50 years. And so his stress level is pretty high right now. And, maybe he will die because stress is through the roof. He just realized he spent $120,000. He's 80 and he has nothing to show for it. Let's go ahead and go back over the whole life policy real quick and check out what age 60 to 80 would have looked like for John if he went with that option. So we've got John's policy pulled up here. We're on age 60. Remember I told you at age 65, the insurance company is going to say, hey, John, we can't take any more of your money. I know you've been giving it to us. I know it's making you bank over here, but that's it. Take your $5,000 that you were spending and go somewhere else with it. Put it into something else. You're all good, buddy. Cool. So at 65 years old, John is no longer able to put $5,000 in. They say no more payments. Everything is free from here on out. So at that point in time, John has put in a total of $225,000 into his policy. That's about $105,000 more than he had put into his term. But he has $449,000 in liquid cash that he could use. He has an $818,000 death benefit. And let's say he decides to retire at this point. He could start pulling out monthly income to live off of from his policy, but we're not going to do that in this example. So let's skip down to age 80, where the term that he purchased would have ended. So as we go down to age 80 here, we can see that John is doing great, just like he was with his term. He's still living and thriving. So at 80 years old, he wouldn't have paid a single penny more into his policy for the past 15 years. Remember, I said at 65, they said, no more payments, John. You just start enjoying life right now. Don't even worry about this. He currently has about $829,000 in liquid cash in his policy. That sounds pretty good. He's got a death benefit of almost $1,080,000, which will also continue to grow every year, just like his cash value. And at this point, he's making almost $31,000 a year passively on his policy. $31,000 a year. He's not putting in a single cent. That is just getting bigger and bigger every single year. You can look at the numbers and do the math. Totally fine with that. So as we wrap this up, let's go ahead and recap and compare which of these two policies cost John more money. Which of these two took more money out of his pocket and never allowed him to use that money again? The two term policies that John purchased at 30 years old and at 60 years old cost him a total of $120,828.90. At no point in time could he use a cent of that money. And if he didn't hurry up and die before the term was over, he was left with nothing at 80 years old. Now, you could have continued with his term, which we kind of discussed, at that ridiculous cost. And that would have by far, if he didn't die soon, that would have easily caught the amount of money that he had put into his whole life policy pretty quickly, or he could have just thrown in the towel and accepted defeat, that he was too healthy and he lived too long and he made the wrong bet. On the whole life side, with absolutely zero banking, because remember, if you did banking with this policy, these numbers would be far better than what we looked at, but we're saying no banking. So on the whole life side, he put in a total of $225,000. Like I said, $105,000 more than he did with the term. He had liquid access to cash the entire time, an increasing amount of cash the entire time. He had every dollar that he put in back by year 12. His policy started making him money in year 6, and every year going forward was making him more and more money than he put in. At 80 years old, he had about $829,000 of liquid, accessible cash and a death benefit of over $1 million, along with an asset that was returning almost $31,000 a year. And again, that number was only increasing. So was the death benefit. So was the total amount of cash value in his policy. You see, guys, when people talk about cost, when people talk about whole life being expensive, cost is only an issue in the absence of value. There's so much value in a whole life policy, a properly structured participating whole life policy, even if you just have a generic all base whole life policy. I'm not talking about final expense, which those are still kind of good. I'm talking about just a generic whole life policy. What that's going to do for you over time is pretty amazing. That is a great asset to have. You cannot compare term and whole life, and you definitely can't compare the cost, because by the numbers, you've seen that the cost, the money leaving your system that you're never going to be able to use again, is far outweighed by the money that you spend that is completely wasted. You can't compare the two. Yeah, sure, it may look like you're putting in more money into your whole life policy, and that's what they want you to believe. Oh my gosh, all these people on the outside, whole life's a scam. I don't even understand that. Whole life has been around for over 200 plus years. It's what countless wealthy people use to protect and grow their wealth. It's a revolving door of being able to utilize your money and still have it continuously compounding for you. There's endless benefits to it, but they've made it a mission. I don't know who exactly, but they've made it a mission, especially Dave, to try and convince you that whole life is a bad place to store your money, that it's a bad investment. And again, I would agree, it's not an investment. Those two things do not go together. We take our money out of our policies and go do investments. Understand that this is just a savings vehicle, the best savings vehicle out there, the one with the most liquidity, the best returns, all of these things. But it is not an investment. But when comparing it to a term, there is no comparison. Do you want to give away your money? Do you want to have less than a 2% chance that that pays out to your family? Or do you want to put your money into something that you know is going to be there for you, that you know is going to be growing, guaranteed, compounding continuously for the rest of your life? Every single dollar that touches the policy will be in there growing for life. At the end of the day, I don't think it's even close. Yeah, sure, Joe paid $120,000 and didn't get to use a single penny of it, and he paid $225,000 or $120,000 into his term and $225,000 into his whole life. But look what the end result was. Which scenario of Joe would you rather be? I can tell you I would rather be whole life Joe. So if you would like to learn more about how we utilize this policy, these properly structured type of policies for infinite banking, how you can pay off debts, create and build assets, and truly start to build a strong foundation of wealth with your policy, all while protecting your family and giving you all the things that you need to feel peace of mind, then reach out. Let's connect. drop a comment below, whatever it may be. Let's get you on a free cash consultation because we'll just talk. We'll walk through the scenario. And if this doesn't make sense for you, then it doesn't make sense for you. But if you're trying to utilize it for banking and you think, Shawn, I'm too old, or Shawn, I'm not healthy enough, believe me, we help people all the time that are in very similar situations. If you want to become the bank, if you want to take advantage of being your own banker and recapturing all the interest that's slipping out of your bank account on a regular basis to third-party lenders and other banks, then by all means, let's have a cash conversation. As always, I'm just here to educate. I want you guys to get educated. I want you to understand what's going on. The information is always free. I highly suggest you read this book. I'll throw it up here somewhere. Read this book, get a better understanding. But the information is free. The knowledge, though, the knowledge is priceless, my friends. You got to act on it. Well, I hope you understand the difference and the cost between whole life and term. I'll catch you guys later. Until next time, peace.